Thanks so much for being here. I know I'm the one thing standing between you guys and the reception, so requires a lot of commitment to be here. I'm going to speak today about what we call internally, actually at Floodgate, intelligent growth, which obviously means that there are other kinds of growth that exist within the world as well. At Floodgate, I've been investing now for almost 10 years, and if I've learned anything, investing in concept is actually quite simple. The whole idea is to get into the very best of the companies in any particular wave, and then hopefully you participate in their growth, and then at the end you have a fabulous exit. But in practice, it's actually a lot harder than it would appear. And so over the last 10 years, I feel like I've learned a few lessons that are relevant, especially for today. And so given that, thought I'd share a couple of thoughts with you. So first is one of the obvious points, which is that building one of these startups is actually really, really hard. And if you just look at the number of unicorns that come out of the pipeline, it's already very difficult. And we've looked at the number of actual exits over a number of years. I did this exercise in 2008 when I first started investing, and we've repeated it over and over again. And always there's somewhere between, 50 and 100 exits greater than $50 million in any given year. But to get to that billion-dollar exit plus, that's actually a really, really hard task. Even $500 million and greater is actually a fairly unique event. And that number hasn't gotten that much larger over the years, even as the pipeline of new seed stage startups has grown exponentially over the last few years. And so that's left us as investors with a big, big problem, and probably for limited partners, it's an even bigger problem, right? Because really, what are we here to do? We're not here to talk about the great valuations of our startups or our portfolio. We are here to deliver cash-on-cash returns. And cash-on-cash returns is not about unicorns. It is about actual exits. And what we've actually found over the last few years is that the dollars going into these companies has also increased. And just from an anecdotal perspective, when I first got started in 2008, it was not unusual for an entry-level engineer to be paid somewhere between $50,000 and $70,000. You could find them from Stanford. Real estate back then, we got into our office building in downtown Palo Alto for roughly $3.50 a square foot per month. If you fast forward to today, right? Stanford students coming out of an undergraduate program with zero work experience are getting about $150,000, right? So we've easily doubled the income. And then if you look at the exact same office space, the space that we are in today, it would probably be marketed for about $9 a square foot. And so the actual operating costs of the business has increased dramatically. So even as we are saying we have cloud infrastructure, open source software, so starting a company is that much easier, the underlying cost, the most important part of the cost of people, has actually increased very much dramatically. And where do we see the impact of that? We see that in incredibly high valuation startups having raised a ton of capital and still having to write off those investments. This is just the list in 2017. There's a far larger list of unicorns that have failed. There are a far larger list of unicorns that are in the process of failing. And this is the deep, dark secret that we hold here in Silicon Valley. So one of the questions that we have to ask is it really necessary to consume this much capital before we learn the lesson that maybe the startup isn't going anywhere? And that, I feel, is a responsibility that we as venture capitalists should very much try to learn and hold. So one of the things that I would point out is that we've really become accustomed to one kind of growth, and I would call it unprofitable hypergrowth. Usually the way you do this is you find a hot startup, you describe this incredible hockey stick growth path, and then your growth stage investors come in and say, if you had unlimited capital, how would you spend it to grow the business faster? And usually the answer from the entrepreneur is, well, I'd probably spend it on marketing, I'd gather a lot more users, I'd grow this business as fast as I could, which ultimately means that that unit economic is no longer a positive unit economic. And in some businesses, it definitely makes sense to build the business in that manner. But I would argue that that's not the only way to build a business. And in fact, the big loss rate for VCs is something that we all talk about. If you have a high-risk portfolio, obviously you're going to have a big loss rate. But you have to ask the question, should we use that much capital to get to this loss rate, right? And so our argument within Floodgate is you have a way of creating value where you build intelligently and you grow intelligently the business. But if you don't do that, you are ultimately destroying value. And we oftentimes in Silicon Valley will love to say that we're creating disruption, we're creating all sorts of great innovation, so we're always creating value. My argument would be if we aren't careful, we actually are destroying value. And so what does that actually mean in terms of the lessons that we have personally learned? And I've learned through seeing a multitude of startups go through lots of different types of cycles. One of the most important lessons I've learned is that you need to hack value before you hack growth. And this might sound very simple, but I would argue most companies that we fund actually try to do both at the same time. And what does that actually mean? When we say you have to hack value before you hack growth, we are telling our entrepreneurs that there is a stage of building a startup, usually at the seed stage or Series A, in which we are asking you to seek truth about the business. And oftentimes, as venture investors, we send out a mixed message. We say, in order to get to the Series A, you have to hit a certain number of metrics, you have to have a certain amount of revenue, you have to have a certain amount of conversion, you have to have a certain CAC with a certain LTV. And so our entrepreneurs focus on those numbers, focus on those metrics, and they lose sight of the fact that they are here to seek truth about the nature of their business. And so they hack growth far before they understand what is the value that I'm delivering to my customer, and in fact, who is the customer that I'm delivering value to. In fact, I would argue that the job of a startup is to accumulate as many customers as possible with the least amount of effort and capital as possible. But if you look at the activity of a lot of startups around us, I would argue it doesn't look like that. They aren't pursuing customers with the least amount of activity possible. And as a result, they aren't actually trying to seek the true value that their product delivers to their customers, nor do they understand who their very best customers are. And so they mix that growth lever with who their best customers are and what value they're delivering, and you ultimately don't really know, you can't tease apart where that growth is coming from. And that's part of the reason that we see a lot of capital being deployed into companies that actually don't have the sustaining value to deliver a great return back to our limited partners. The second phase of growth seeking is then to figure out what are the levers of your go-to-market that allow you to accumulate as many of these customers as quickly as possible. And again, in this phase, what I believe is now you're trying to figure out what's the nature of this business, right? It's not about, you already know what the value is, but you're trying to see how big is this market? How easy is it to access these customers? How fast can you truly grow? And if you have truth around all of these different elements, then and only then do you understand whether or not this is a venture backable business that into which you should dump a lot of growth equity into, or if this is one that you should grow slowly and organically. Some of the best companies have done that. So if you look at what does this truth-seeking really look like in practice, I would posit that one of my portfolio companies, Lyft, was a great example of this. So I invested in Lyft when I was 9 months pregnant in a $1.2 million Series Seed with my second son. I still remember that. And I put in this Series Seed along K9 Ventures in Manu Kumar. At the time, Lyft was a platform. It was called Zimride. We sold the platform to a number of universities, and we were trying to enable the transportation revolution by having Facebook profiles connected to a transportation profile so that more people would carpool together. And our belief was it's a little bit awkward when you carpool because sometimes you need to ask for gas money or toll money. People didn't like to do that. So if you could include transactions into that system, would you actually enable more people to carpool? It turns out that the platform itself was quite valuable to universities. A lot of universities needed to have a platform like this because they had a guy or a gal who was in charge of parking. And oftentimes their parking facilities were overloaded. So they needed to figure out a way to say they'd created a solution that would reduce congestion within their campuses. It wasn't actually solving a problem for a lot of the students, though, because the students would come into the platform, maybe they'd find one match, but it's kind of hard to find a good match. And so they'd come in, they might leave. We didn't really have great product market fit from an engagement standpoint. Part of the belief was, well, maybe we don't have enough distribution and density within these networks. So if we add corporations, then you can actually start to have density along the entire peninsula. So we add Facebook and Intuit and other corporations, just even within the peninsula. And based on that, and based on the traction of selling the platform, they were able to raise a relatively small Series A, $6 million in 2011 with Mayfield. But they were still trying to figure out, how do we get more user engagement? How do we get more people into this platform, understanding what we're doing? So they started experimenting with a lot of different things. They did bus routes. And one other one that they did was the long distance routes where Logan Green, the CEO, would literally drive a van on Saturday or Friday morning down to Los Angeles and then drive it back with passengers, and we would advertise this on Craigslist. And so as you can see, there's all these different ideas around the same concept of we believe the value is that there's going to be density within a network and people will want to share the ride. Couldn't figure out how to deliver that product that would enable that value, but they kept iterating on it. It was not until the summer of 2012, so 2 years into my investment, that they then said, this mobile revolution and this thing we're seeing with black cars is obviously going to be true for peer-to-peer. And so is there a way to then deliver this Lyft experience? And they demonstrated this application over the summer and launched it in August of 2012. And obviously that, I still remember to this day, we had a young associate who ran into my office and said, "And you won't believe what you have on your hands. I've taken a Lyft 6 times in 3 days. It's incredible." That to me was product market fit. But they had only spent $7 million getting to that product market fit. And it took 2 years to get there. But they were capital efficient. They worked with a very, very small team. And they knew that they had to experiment upon these ideas. And only in 2013 did they raise their rather large round from Founders Fund. So it gives you a sense of what does it really mean to actually seek truth before you then go aggressively into a market and try to seek out growth. So we believe actually within Floodgate there are multiple growth profiles. And in fact, at the seed stage, you may discover that you don't necessarily have this incredible venture backable model of growth. And part of truth seeking is to be completely honest between the venture investor and the entrepreneur, because we all know that at the seed stage there are lots of things that we don't know. So one of the models is obviously unprofitable hypergrowth. We already talked about that. We've seen actually profitable hypergrowth time and time again. In fact, I think Viva Systems is the best example of that. I think they raised $4 million and then had an IPO that made the company worth multiple billions of dollars. That kind of profitable but IPO-ready growth for a SaaS business is incredible. And that's the kind of thoughtful growth that results in great returns for our limited partners. We've seen a few other types of growth models. So one I would call linear growth. This could be for Main Street businesses. We've even seen this within our portfolio companies. We have one portfolio company that's throwing off about $200,000 a month in cash. But their fundamental business, they believe, is not one that is really a hyper-growth business. And so they're reinvesting those dollars into finding the next great consumer application that will hit it big. And so they're trying to use that profit to then find the unprofitable hyper-growth business. We also have seen, profitable decline businesses. And I say the canonical example here is if you were back in the days when the car companies came about and you're selling buggy whips. You're probably in a declining market if you're selling buggy whips, but you could actually profitably decline that business. We've seen PE companies actually come into some SaaS businesses and really try to take the cash out of those businesses. These can actually be profitable investment models. There is actually one more value profile that we've seen in the market. And we call this last bucket the denial profile. And the denial profile, in honesty, is actually one of the more predominant profiles. They are unprofitable, stagnant companies. And the problem here is that it is a lack of this truth-seeking or curiosity on the part of board members. We all need to be honest, not only with ourselves, with our partnerships, with our entrepreneurs, as to what kind of profile they're in, and hopefully you can have a discussion if you are stuck in this denial profile. Because we believe that value profiles are a combination, and I think this is a really important point, of both ambition and acceptance. There's something inherent within a business about what their growth profile ought to be, and you shouldn't try to take it out of that value profile. But if you have a great value profile, then you should invest heavily into it and grab the market. But you can't force a value profile onto a company. And oftentimes that's where we fail, both our board, we fail our entrepreneurs, we fail our other partners, we fail our limited partners. And by being honest in the discussion about both ambition and acceptance of your value profile, we at Floodgate believe that you can actually lead your company to a really healthy path and potentially find the great hypergrowth business that is latent in the observations that they have of the market. I also think that these different profiles, it's interesting because if you look at the last two, we say it's not necessarily VC ready, right? But there has to be a way of actually investing, particularly into profitable businesses that throw off great returns for the limited partners. And I feel like we need to be more creative as investors, as limited partners, in figuring out how to better invest into these businesses. I think Bryce Roberts is an example at ND.VC is doing a great job of trying to figure something out. But the rest of us also should be trying to be more creative in figuring out not only ways to support entrepreneurs who are on this path and on this journey, that may actually eventually stumble into one of these growth models. But truly, this massive democratization of entrepreneurship is going to result in many, many more kinds of entrepreneurs. I think that the fact that we are seeing these ICOs suddenly come up is clear evidence that there are different models that can actually fund these types of businesses. But again, we have to have clear product market fit between the product that we're offering as investors and the ambition of the entrepreneurs. And to date, one of the massive lessons that I've learned as an investor has been the one that I learned through Lyft, which is you actually have to have a combination of patience, but also you have to find that inner ambition of that entrepreneur to make sure that you push them in the right moments, but also that they are able to target a market that is truly big enough. We found in the venture industry for ourselves, as we look through the data that both our LPs have provided, but the data that we have on ourselves, there's always that one or two companies within any portfolio within a fund that really returns the massive returns within that fund. And even at the seed stage, those dynamics exist. People have talked about it for Series A and beyond. We see that at the seed stage. And so our ambitions still match those of the later stage investors. And so for us as Floodgate, we're still investing in those top two profiles. But my hope and my dream is that we also can support the types of entrepreneurs who are coming up, because we've also seen that some of those businesses that have a more linear growth profile ultimately can end up being one of the hyper-growth businesses. The most important lesson is to be truthful in your dialogue between investors and entrepreneurs about what you know, but also what you don't know about your business. And lastly, as a parting thought, I also think that one of the things that we've often emphasized is product and business model, and not enough around what else are you building. One of the things that we've seen within the conversations we've seen today is that these companies are not just building product. They're not just building technology. They're building a living, breathing organization. And unless we're supportive of them in the hypergrowth phases, as well as in the early stages of building world-class organizations, then they themselves can falter even if there is massive product market fit. And so as investors, it is our obligation to really think about those things and not just one part of the business, but the full stack of the business. And only then can you unleash the potential of what we see as intelligent growth. Thank you.